Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Biden urges Israel not to attack Iran's nuclear facilities in retaliation for a missile barrage. The G7, meanwhile, is discussing further sanctions on Tehran. Hong Kong stocks slip as traders book profits following massive gains. The yen resuming its slide after Japan's new prime minister surprises with a warning to the Bank of Japan against raising rates. Plus, UAE renewables firm Masdar continues its shopping spree with the acquisition of a U.S. company. We speak to the CEO about clean energy and global expansion. Well, good morning again. It's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Let's get you up to speed on how some of these markets are faring. And again, geopolitical news right front and center for many of these financial assets. The S&P struggling to hold on to the gains of the last couple of weeks. In fact, we are actually on track for a negative week for the S&P. We had a slightly weaker close yesterday. Today, futures not doing much. We are slipping a tad, down about 15 basis points. And of course, the other major event from a data perspective is that NFP print coming out tomorrow. ADP numbers stronger than expected yesterday. Does that signal anything for the numbers coming through tomorrow? Big question for investors. The USD also holding on to some gains, up about 16 basis points. The dollar is actually up 1.2% this week, so some firmness coming back into the greenback. 10-year yields also moving higher, just shy of 3.8 now. Another day yesterday where we saw yields start creeping higher, about 4 or 5 basis points over the course of the session. So stronger dollar, higher yields has been the theme for these U.S. markets. And then Brent, obviously a lot of focus on the energy complex, given all of these questions circulating about what form Israel's reprisal on Iran could take. And there's some talk out there that they could target energy infrastructure, hence some of the price action we had in the last 24 hours. But let's not stop there and also take a look at what's happening with these Asian markets today, because we're seeing a bit of a breather. The Hang Seng is down 3%. The Hang Seng Tech Index down 5%. So it tells you that even though we've had an enormous rally in the last 2 weeks on back of that China stimulus announcement, we are seeing a bit of a pullback today. Perhaps people are taking some chips off the table. And then also special focus on Japan this morning as well, with some of the dovish commentary coming through from the new prime minister, signaling that the Bank of Japan shouldn't be in a hurry to continue with its hiking cycle. So on the back of that, some weakness coming through on the yen. It's about 2% weaker just in the last 24 hours. And then the Nikkei liking that dovishness. Obviously, the Nikkei seeing a bit of a rebound to up 2% in trading this morning. But back to our top geopolitical news from the region. President Biden is urging Israel not to attack Iran's nuclear facilities in retaliation for this week's missile barrage on Israeli cities. Biden says he plans to speak with the Prime Minister Benjamin Netanyahu as the U.S. and its G7 allies plan further sanctions on Iran.
Iran's missile strike were a necessary and proportionate response to Israeli continued terrorist aggressive acts over the past 2 months. The regime is pushing the region to the edge of an all-out, unprecedented catastrophe. Israel has no intention to pursue peace or a ceasefire.
We are in the middle of a tough war against evil axis of Iran, which seeks to wipe us out. This will not happen because we will stand together, and with God's help, we will win together. We will return our hostages in the south. We will return our residents in the north. We will guarantee the eternity of Israel.
Stuart Livingstone-Wallace is our executive editor for Middle East, North Africa and Russia, and joins us here in the studio. Stuart, have we learned anything new in the last 24 hours about how Israel are likely to respond to the Iran attack?
So it seems to be a range of options. And I should stress at this stage that we're not privy to the planning going on inside Tel Aviv and Jerusalem, but we're going to make an educated guess. And I think the most likely targets are probably, number one, the missile sites that launched the missiles a couple of days ago, the aerial defenses. These are all certainly within the range of Israel's capabilities. And then we get into more tricky waters. So oil infrastructure, that is definitely on the table, but clearly not something the US would be particularly pleased about either when we're this close to the election, because it's definitely going to impact oil prices. You've already seen it. Imagine what Brent crude will be trading at if they take out Iran's oil export facilities. And then last, the one that Biden, I think, is also very fearful about, the nuclear sites.
Yeah.
It is broadly thought that Israel would struggle to take out those sites alone. They're going to need US help. And in part, that's because of the distance involved and the depth at which many of those facilities are. So they can definitely do damage. Can they really take them out? No. And there is a secondary risk here, is that after several months, it may push Iran into acquiring a nuclear weapon. It may basically put Iran in a position where it feels it's backed into a corner, it has no options, there's no more deterrence left, it has to go for the nuclear option. And then that is a catastrophic scenario for the region because everyone else is going to want one as well.
Is there a sense, Stuart, that the reprisal this time around from Israel is going to be more forceful than what we got back in April?
Yeah, I mean, I think it has to be. And it seems a broad spectrum of support within Israel for that. The response that we saw back in April was, relatively speaking, a very small one. Given the speed at which the Iranian attack came this time, its magnitude and the kind of missiles used, you know, there's ballistic missiles that move incredibly fast and therefore give them less time to defend themselves. Yes, it has to be more than just a drone attack.
Yeah, so the U.S. came to Israel's support yesterday in intercepting some of the missiles that were fired towards Israel and over central cities. Now, in the response, how crucial is it for Israel that U.S. also are participating, or will they have some form of participation?
Yeah, so they have. The U.S. has already said publicly, we will be part of the response. Now, quite what that looks like, who knows? It could be intelligence, it could be refueling support, it could be attacks themselves. Again, I think the U.S. is going to be quite reluctant to engage directly, because in effect that starts a whole new phase of the war. Now, it has the firepower to do that. It certainly has the capability. But again, you know, we are very, very close to the election. The last thing the U.S. wants right now is to be dragged directly into a confrontation with Iran.
Yeah. Stuart, all right. We'll see what happens. Extraordinary times. Bloomberg's Stuart Livingston-Wallace, executive editor for Middle East, North Africa, and Russia. And still ahead, we get the outlook on oil from Ziemba Insights founder Rachel Ziemba as Middle East uncertainty gets factored into these markets. Plus, we'll be speaking with the CEO of Masdar about the prospects for green hydrogen in the region. Mohamed Jameel Al Ramahi joins us later this hour. But first, Standard Chartered Wealth Management's Manpreet Gill discusses the latest market moves as Asian stocks diverge ahead of the U.S. payrolls data. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Asian markets diverging this morning. Japanese stocks gaining as the yen drops, while the exuberance over Chinese equities fades in Hong Kong. Oil is gaining for a third day on Middle East risks. So lots to talk about. Let's bring in Manpreet Gill, Standard Chartered Wealth Management, CIO of Africa, the Middle East, and Europe. So even just in that introduction to you, I've highlighted several themes that are going on in the markets right now. You've got the China stimulus theme. You've got some dovishness, renewed dovishness coming through from Japan, the new Japanese Prime Minister. Geopolitical risks, and then, of course, all of the developments in the U.S. as well with the Fed cutting cycle and that big NFP event coming up tomorrow. Which one of those narratives do you think is going to dominate price action until the end of the year?
Well, all of them, if I can say so.
I guess it depends where you're positioned. Yeah.
Yes, and I think from a portfolio perspective, I'd start with the positives, because I think in China, you know, amidst all the gloom, of course, you know, that what we've seen there, in our view, is a positive, at least for the short term. Look, markets in China have rallied a lot, but we think there's still a bit more to go, at least in the short term, if you just think in terms of the range onshore equities have been in now for more than a couple of years. But a lot of it, of course, liquidity, monetary policy driven. The big turning point potentially could be if we get more on the fiscal front. I think that would be the one I'd keep a watch on. On the negative side, of course, a lot of focus on geopolitics, no surprise. But in terms of the risks out there, I think oil prices and whether there's a need to consider hedges via energy sector equities, I think that's perhaps the other theme we're keeping an eye on. But really at those two extremes of a broader portfolio.
So let me just pick up on what you were saying about Chinese equities, because we have come a very long way in a short period of time. Do you think that in order to continue continue with this rally, for us to see another leg higher, you would actually need to see more forceful fiscal support, because whatever has happened now has already been priced in.
To some degree, and I'd say that the speed of the rally was aided by a lot of technical factors. I think there was a lot of underweight positioning. There were surveys out there showing that many international investors had very low or zero positioning. So I think there was a little bit of catch-up involved, and you see that in the flows data. But after this sort of big surge, I think we can go back to focus on what the fundamental signals are telling us. And from a policy perspective, look, what we got was a significant package of stimulus measures. A lot of those on the monetary side, and signals that there's more to come. What we think was the most significant, of course, was the fact that we got a positive signal from the Politburo. So I think the big turning point would be if we saw more action from the fiscal side. I think from a market perspective, that may be more significant.
Where would you advise people to put money right now into the end of the year? Would you rather be in Chinese equities or Chinese exposed markets or U.S. markets?
A little bit of both. I don't think you can completely, leave sort of U.S. market exposure aside. I'd say in the short term, China is clearly a theme, even at a broad market level. But I think there the key is, like we said, the policy framework and the extent to which this rally goes. The other way to think about how to maintain exposure to both is just take a sectoral approach. Because in China, for example, we like the consumer discretionary sector, so one of the sectors we like, which should benefit more directly if there's more fiscal stimulus coming. In the U.S., though, for us, it's about broadening exposure because the theme of falling interest rates, that's positive, of course, for sectors like tech, but we'd rather broaden include healthcare or financials rather than take sort of that focus bet alone.
Yeah, it's interesting because I feel like I've spent the whole year talking about tech and the AI sector in the U.S., but actually I was just looking at some of the data this morning. Tech sector is only the third best performer in the S&P 500 year to date, which is surprising given how much we've spent, how much time we spent talking about the tech sector. Do you think some fatigue is setting in there?
Well, I think fatigue might be one way, but also that the fact that there are many ignored sort of opportunities in the market. Because if we go back over the last, let's say, 2 years, a lot of our discussion has been about why this rally has been almost entirely led by tech sector. I think we're getting to the point now, as interest rates come down, that there's room for catch-up. At the end of the day, if the rally has to broaden and continue in a soft landing environment, we think that will involve some catch-up, of course, by other sectors as well. The two we like, of course, are financials and healthcare. I think financial at least might be another way to benefit directly from perhaps not falling rates, but at least continued sort of credit growth, the steepening of the yield curve, we think are positives, besides the catch-up, of course.
I do want to ask you about financials, because if we are headed to an environment where the labor market continues to weaken, then you start seeing a rise in unemployment, and obviously that's going to have knock-on effects to the real economy. Isn't that going to backfire on your financials trade?
So I think that sort of rolls up to what I describe as the key risk. Because I think in our baseline scenario, you're right, job market is perhaps the most important thing to watch over the next few months. We see data slowing, including the job market. We think a soft landing is still possible, in which case financials, broader markets still do okay. You're right that if we see an unexpectedly rapid slowdown, it won't be... The downside won't be limited to just financials. But that's why we think adding healthcare to the mix adds a nice barbell. That's why we think a balanced view between equities and bonds at a broader level. In our view, those are ways to manage the risk. And not to forget gold. At a broad portfolio level, we think that's another way to manage what we think will be a relatively more volatile last 3 months of the year.
Yeah, and also potentially another geopolitical hedge to add to the mix as well. Just a final question. Given you've articulated your views of where you want to put your money, how do you think the market may change its perception of how things are going to do depending on who wins the presidential election?
So I think with Harris, I think there's clearly a theme of continuity. I think markets might move on quite quickly from that. With Trump, we know, of course, we have the usual sort of Trump trades. I think the risk with the elections is more that it can create some short-term volatility, not necessarily one that changes the trend, but in the days and weeks around the election, we have seen that before. And the fact that, look, we know election years tend to be good ones for markets, but we have already seen quite a rise this year. So again, feeds into, in our view, a theme of short-term volatility rather than sort of any significant swings either based on either candidate.
Interesting. Manpreet, always good to chat to you. Thanks so much for coming on our show today. Manpreet Gill, Standard Chartered Wealth Management, CIO of Africa, Middle East and Europe. Thank you. Now let's turn to Europe. The French President, Emmanuel Macron, says a lack of investment and too much regulation could make the EU uncompetitive against the US and China. His comments echo former ECB President Mario Draghi, who warned last month of an existential challenge.
it's super important to assess fairly the fact that our former model is over. And this is not a question of adjustment. This is not the same world, 2024, 2025. And on top of that, we are making the same mistakes on top of the key elements I mentioned. We are over-regulating and under-investing. So just if in the 2 to 3 years to come, if we follow our classical agenda, we will be out of the market, I have no doubt. So I think what we have to deliver in the 2 to 3 years to come is capital market union. My view is that we have to rush on energy beyond what we already decided, which will be implemented for 2026, which will avoid the big peak and the instability of the energy market we had during the past few years. We corrected that, but we have to go much faster and further. And we need this investment shock I mentioned. And I think the simplification agenda and let's say, pause in terms of regulation, but even deregulation in some issues, it's absolutely critical.
Can you have any investment, can you have that investment shock without issuance of joint debt?
I think, the best way to deliver is not to create big trauma at the beginning, by experience.
But you persuaded the Germans before, can't you do it again? This
is true, but I was... if I want to be fair, I was a little bit helped by a colleague called COVID-19, and it changed the reality. But what I think we have an external systemic shock. I think we have to assess that. During the pandemic, we all experienced a symmetric shock for all our economies. And this is why we made this move with Chancellor Merkel. And I think it was a unique move, and this is really, for me, a fundamental change of our EU. Now, I want us to be totally aware of the fact that we are living a symmetric shock on our economies whose scale and magnitude is underestimated.
That was French President Emmanuel Macron speaking on a panel moderated by Bloomberg's Stephanie Flanders at the Berlin Global Dialogue. Now, coming up, bondholders in Ethiopia are being asked to take a haircut as part of a debt restructuring plan. We have all the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Well, Ethiopia is asking bondholders to take an 18% loss in a debt restructuring. The government and global investors are discussing a debt rework strategy after a $3.4 billion loan from the IMF. At the heart of the issue is a forecast about the degree of economic hardship facing Ethiopia if it makes the larger payments. So let's bring in Bloomberg's Ondiro Ganga, who joins us from Kigali. So first of all, Ondiro, why is the country asking bondholders to take a loss? This is obviously typical of a debt restructuring, but just give us a little bit more context.
Jumana, so what we know so far from this story is that Ethiopia, under the illustrative debt treatment, will be asking them to take an 18% nominal haircut on the $1 billion Eurobond that they defaulted. And they will also be proposing that they will be paying their coupons twice a year in June and in December. And they're also saying that they want to push the maturity date from 2024 all the way to 2031. And more proposals are things like ensuring that the capital repayment is done in 9 equal installments. Now, it's very important to remember that Ethiopia is currently using the Group of 20 framework to try and restructure its debt, including $12.4 billion that it owes to external creditors. And under this framework, the IMF debt restructuring analysis lays out economic parameters that are needed and dictates how much relief lenders are supposed to give to some of these countries that have defaulted to ensure that the restructuring process does not bring these countries to their knees, including countries like Ethiopia. And, ever since they secured the $3.4 billion bailout package from the IMF, they now need to renegotiate the debt that they owe to bondholders and country-level creditors. So it's really important because the country, ever since its default, has been going through a couple of issues. They've had to put in place reforms to ensure that they can be part of the IMF program and they can start the debt renegotiation process.
Ondiro, and of course that's one side of the equation. The other side of the equation is whether the creditors actually accept the terms of the debt restructuring and the haircut. How likely is it that they accept?
Well, it's not likely that they're going to accept it, particularly not this early on in the negotiations. The state minister, after the call with investors, said that they were reluctant to accept any form of haircut. And it's important to remember that they are the majority holders, about 40%. So if they want to block these negotiations, they'll easily do it. And even in August, a group of creditors dismissed talks about reduction of the principal amount, saying it was not necessary to begin with. And if we look at some of the contentions that these bondholders have with Ethiopia, they're saying that Ethiopia is able to make these repayments. They might have a small liquidity crunch, but they're able to do it. Ethiopia, on the other hand, says that if they do it, then there'll be solvency issues. Already they've made concessions. If we look at some of the reforms, they've floated their currency after a really long time. And because of the liberalization of the FX market and trying to converge the parallel and the official market, the currency has lost over 40% of its value. Inflation is near 20%, and this is a country that has been ravaged by drought, by civil war, and just continued instability locally, with a lot of money going into the capital-intensive infrastructure. So it's bound to be a really long road ahead if Zambia is anything to go by. Zambia's restructuring took 4 years. So if Ethiopia takes the same road, it's going to get harder before it gets easier.
Yeah, it's certainly, and Zambia is a very good example of how long some of these restructuring talks can take. Bloomberg's Ondiro Ganga, thank you for the report on Ethiopia. Well, a quick look at markets before we head to the break. We have somewhat of a negative handover today from Asian markets, taking a breather after the big run-up we've had in the last couple of weeks post the China stimulus announcement. Today, S&P futures and year futures all pointing to the red. But coming up, we're going to be talking more about oil and oil supply risks. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Biden urges Israel not to attack Iran's nuclear facilities in retaliation for the missile barrage. The G7, meanwhile, is discussing further sanctions on Tehran. Hong Kong stocks slip as traders book profits following massive gains. The yen resuming its slide after Japan's new prime minister surprises with a warning to the Bank of Japan against raising rates. Plus, UAE renewables firm Masdar continues its shopping spree with the acquisition of a U.S. company. We speak to the CEO about clean energy and global expansion. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai, and what we are getting today is a slightly subdued session. The handover from Asia, somewhat negative. These Hong Kong stocks, Hong Kong in tech stocks also taking a bit of a breather after the massive rally we've seen the last couple of weeks. So the handover into U.S., into European session has been somewhat negative too. S&P futures leaning about 16 basis points weaker. All eyes on that NFP print that comes out tomorrow. Yesterday we had an upside surprise to ADP, so we'll see whether that has any implications for tomorrow's reading. Will be a significant one, of course, for the labor markets in the U.S. But on the back of yesterday's ADP upward surprise, we got strength in the USD. We're seeing that this morning. It's up about 15 basis points. And of course, you factor in everything that's happening geopolitically as well. We're seeing a bid for the USD. 10-year yields also moving about 4 or 5 basis points higher over the course of the last 24 hours. So just sitting shy of 3.8% now. And then Brent, a lot of talk about what is happening in the energy complex. And here, for once, we have geopolitical concerns actually driving the move higher. So Brent is sitting just shy of $75 now. We're up about 5% in the last couple of sessions. But I did mention some of the price action in Asian equities, just to take a quick look at what's been happening there. Yen in focus once more, some dovish commentary coming through from the new prime minister, suggesting or saying that the Bank of Japan shouldn't be in a rush to continue with its hiking cycle. So on the back of that, we've seen weakness in the yen the last couple of days. It is down 2% versus the USD. The Nikkei also up 2.2%. So continuing with that correlation between the two, weaker yen, good for Nikkei. And then Hang Seng, I mentioned earlier on, down 3%. And then the tech index also down 5% as well. So somewhat of a breather for these Asian markets as we head into the European session. But let's go back to oil, because the oil complex is rising for a third day as traders watch for supply risks in the Middle East, with Israel expected to make a retaliatory strike against Iran following Tehran's missile barrage. The U.S. is urging Israel not to attack Iran's nuclear facilities, a move that some Israeli politicians have been calling for. Markets fear an Israeli attack on Iran's oil exporting capacity could take up to 1.5 million barrels of daily supplies off the market. So let's bring in an expert on this topic and more, Rachel Ziemba, Adjunct Senior Fellow at the Center for New American Security and founder of Ziemba Insights. Thanks so much for coming on.
It's a pleasure.
Rachel, what do you make of the price action we've had in oil the last couple of days? For once, it feels as though energy traders are actually pricing in the possibility of an actual supply hit.
And I think that's the key thing. It's that traders have been in a show me the outage moment, right? In the Middle East, there's a lot of things that can happen that can be damaging to regional and global stability without moving the oil markets, unfortunately. Some people only pay attention when oil moves. But here we're talking about energy infrastructure and facilities, because it's been notable, with the exception of a few days there where concerns about tankers going through the Red Sea, traders adjusted to that, right? It costs more. But I think we are now raising this question of, could Iran's oil infrastructure be targeted? Could Israel's offshore industry be targeted? That probably wouldn't move global markets. But also, Iran has publicly said if Israel strikes its facilities, what might happen to Gulf facilities? Now, that's an escalatory tit for tat. But I think the oil markets that had been selling off sharply on weak demand and very ample excess supply, right, in the Gulf, are sort of now saying, you know what, maybe there's more of a risk here. And I think we'll need to sort of wait and see what Israel's response looks like.
Yeah. So our energy colleagues on the BN site, the Bloomberg News site, put out an Energy Daily yesterday. And they're saying if Israel really want to strike Iran precisely on their energy infrastructure, one place that they could go for is the Gulf Star refinery on the Strait of Hormuz. And that one is responsible mainly for the processing for the oil that stays in domestic. Iran. Exactly. It stays in Iran. It accounts for about 45% of their daily gasoline. If that does happen, what would be the reaction to global oil markets, given so much of the processed oil from that refinery actually just stays in Iran?
So arguably, it would have less impact on global markets. Iran's demand is relatively small. There would be a worry. I think it would still feed into higher prices and concern, because how would Iran respond? Now, Iran is under sanctions. They've had to scale up their own domestic refining capacity because they can't easily import oil from other countries. Also, if they import oil from other countries, then they can't buy other goods. So I think that would be a hit domestically, maybe not a lot internationally. We've seen, if anything, we might actually see Iran trying to export more crude oil in that circumstance. That's something that happened recently with Russia when its refineries were attacked by Ukrainian drone strikes. But of course, Iran's context, they have a much tighter domestic refining capacity. And this issue of where are they going to get the parts, where are they going to rebuild. Israel might look at it and say, well, their core interest is weakening Iran's economy and regime. They've said publicly they want to give Iran a financial hit that has various implications. But my worry would be that such a major attack might not have a lot of impact on the market short term, but it would be a big escalatory attack.
Of course.
And that's something I know the U.S. is very concerned about. Regional partners are very concerned about as well.
Yeah, a few analysts are throwing out triple digits again, saying that oil could get as high as $100. Under which situation would that happen, do you think?
Yeah, so I mean, I think what happens once you start to price in big outages, then for a brief period of time, nobody really knows where things are going to settle. I think at the end of the day, the situation that concerns me most is anything that impacts Saudi Arabian infrastructure, Saudi Arabia and UAE ability to get the current production, but also the excess capacity that's sitting on the sidelines. Right until a few days ago, our big topic of conversation
is spare capacity in the region, of course.
Exactly, and there's still and the JMMC, my apologies, sort of met again yesterday and said, we're sticking to our plans, and non-compliers better get in line so that we can do that. So I think really, there's always this tail risk concern of could anything block the Strait of Hormuz for a period of time. That I think is a very much extreme tail risk scenario. And under what circumstances would Iranian supplies come off the market? Theoretically, Saudi Arabia and the UAE could easily replace. But one of the things that I think has tamped down risk in the region is not only the excess capacity, but also the fact that Saudi Arabia and the UAE had a sort of agreement not to attack each other's infrastructure. We've not seen reprisals.
Saudi and Iran, you mean?
Saudi and Iran. We have not seen the Houthis attack Saudi and Emirati infrastructure. That, I think, has been a dampening effect. I'm not saying in this escalatory scenario all bets are off, but in those circumstances, at the end of the day, that kind of price shock, though, would, in the face of the sluggish demand that we're already seeing in China, I think probably would be negative for the global economy.
So just final question for you, and I should tell viewers that you and I bumped into one another at the Energy Markets Forum in Fujairah a couple of days ago. How was the mood there? What were the industry leaders saying about the outlook for oil and energy from here? Yeah,
it was wonderful to see you and to connect with everyone. It was a mood of concern about demand, particularly in China. I would say, and which switched, I think, the Iranian missile strike happened, I would say, in the middle of the conference. So I think that added a pall. But at the end of the day, I think that this was a time of recognizing that OPEC Plus has sort of come together, that they have provided some baseline stability to the markets. And I would say that there was a lot of concerns and questions about what economic and energy policy will look like out of the United States going forward. But at the end of the day, caution, but not and concerns to manage about the long term. There was perhaps less worry about the risks from ESG and the energy transition. That is now part of the story, and this recognition from industry leaders that they feel that there's an understanding that fossil fuels are going to have to be part of the energy mix for time to come.
Well, that's a very nice segue, because we've got Masdar CEO waiting on the sidelines to come on this show. So Rachel, thank you so much for joining us. Rachel Ziemba, Adjunct Senior Fellow at Center for a New American Security and founder of Ziemba Insights. Thanks. Now, coming up, the CEO of Masdar joins us next as the renewables firm adds another company to its basket as part of its global shopping spree. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersechi in Dubai. Abu Dhabi-based energy company Masdar says it has completed its acquisition of a 50% stake in U.S. renewables developer Terra-Gen. This significantly expands the company's footprint in the U.S. as it moves ahead with ambitious global growth plans. Let's bring in Masdar CEO Mohamed Jameel Al Ramahi. It's great to have you with us on the show. So just talk to us about this latest stake that you've taken in Terra-Gen, 50% stake. You have been on an acquisition spree as of late. How does this latest acquisition complement your portfolio?
Good morning, Juman, and pleasure to be with you today. So yes, we just announced our acquisition 50% share by Terra-Gen. Terra-Gen is one of the largest independent power producers in renewables in the United States, mainly focused on two states, California and Texas. This is addition to what we had already been developing or acquired over the past years. You know, Jumana, we have a target to achieve by 2030. This target is 100 gigawatt, focusing on key technologies, mainly solar, wind onshore, wind offshore, and battery storage. Over the past 2 decades, we have invested in other solutions as well. For instance, alongside our partners in Indonesia, we have the largest geothermal platform in Southeast Asia and one of the largest in the world. And over the past year, you've heard that we've been very active in Europe. Recently, we have announced our interest to acquire Brookfield platform in Spain or the Iberia Peninsula called Sieta. And earlier this year, we have also announced a partnership with Endesa, one of the largest utilities in Spain, by acquiring almost 50% of one of the largest solar portfolio there in the Kingdom of Spain. And of course, on top of all of that, we've also announced our interest to acquire majority share of a publicly listed company in the Athens Stock Exchange called Terna Energy. Terna, as a company, is one of, if not the largest renewable energy company in Greece. So as you can see, we have been very active this year. In fact, we have been very active since the new Masdar was announced late in 2022. If you recall, Jumana, we were established in 2006, incubated by Mubadala, our sole shareholder. And then late in 2022, we welcomed 2 new shareholders alongside Mubadala. So now we have Tata, one of the largest utility companies in the world. We have ADNOC, one of the largest energy companies in the world. And we have Mubadala, one of the largest sovereign wealth fund in the world, as 3 shareholders within the company. That, of course, changed the way we approach the market and obviously allowed us to accelerate our growth, trying and striving to achieve that aggressive 100 gigawatt target by 2030.
Sir, so let me just pick up on that 100 gigawatt target by 2030. That's your gross target, but that includes all of the companies that you have stakes in. What would you say is the actual net target for Masdar on a standalone basis?
So when we started in late 2022, when we welcomed our new shareholders to Masdar, we started at a portfolio capacity of around 12 gigawatt. We doubled that, we actually more than doubled that in 2023. And in 2024, based on the current track that we are pursuing, we are hopeful and we are confident that we will close the year with a capacity circa around 32 gigawatts. So we are well on track to achieve the 100 gigawatt capacity based on the success rate that we have. You have to also take into account, Jumana, that the way we are approaching the market has different strategies. One, obviously, the one that has been highlighted over this year is through M&A activities. But as you can imagine, Masdar is a renewable energy platform, has been in the business of renewables for 2 decades.
Right.
So we have the skill set, we have the know-how. So greenfield is a very important aspect of our growth as well. So last year, for instance, we inaugurated one of the largest solar farms in the world here in Abu Dhabi, Al Dhafra, which is almost 2 gigawatt on by itself. We've inaugurated Jeddah Solar Park. We've inaugurated the largest solar farm in Azerbaijan last year, 230 megawatt. We've also inaugurated one of the largest wind farms in Central Asia. So our growth is based on greenfield activities, of course, and M&A activities. And that's the only way we can achieve such an aggressive target.
Yeah. And let me just ask you specifically about the update with Egypt. I know there you've announced plans for the 10 gigawatt wind project. But of course, within Egypt, there has been a lot of resistance, opposition to export some of these green energy to external countries. Are you planning on proceeding with that project, given some of the opposition you're facing there?
Jumana, we are not only committed to Egypt. In fact, Egypt has been and continues to be a very important and strategic market for us at Masdar. And we do it directly and indirectly. So what do I mean by that? I mean that Masdar is active in Egypt through Masdar Direct, and it's also active in Egypt through its Africa platform, Infinity Power Holding, which we own almost 50% of that platform. And today, Infinity Power is the largest renewable energy platform, not only in Egypt, across the African continent. And yes, we are developing giga projects in Egypt. And of course, like you have highlighted, Jumana, there has always been strategic discussions across different continents, connecting Africa to Europe. This has been always on the map and in the strategic discussions at high level between nations and countries, but also it has also attracted a lot of interest from the private sector. So yes, this is something that we are thinking of. It has always been on the map. Today, you have interconnection between Morocco and Spain. This interconnection has been there for more than 2 decades. Is it possible to connect Egypt to Europe? The answer is yes. Is it possible to connect Tunisia to Europe? The answer is yes. So there are a few interesting interconnections that we believe in. In fact, we support, and we believe that such interconnection creates opportunities. Such interconnections create prosperity, and it will help in the decarbonization process that we are all committed to achieve, which is the net zero target that we have all signed off on.
Yeah, well, there's a lot more I wanted to ask you, but hopefully we can have you come back on the show another time. We're going to have to leave it there, sir. Thank you so much for speaking with us today. Mohamed Jameel Al Ramahi, Masdar CEO, thank you for your time. Now, coming up, rising tensions across the Middle East is creating aviation disruption as airlines divert or cancel flights. This is Bloomberg. Let's turn to aviation now. Airlines connecting Europe with the Middle East and South Asia are being forced to fly longer routes using Egyptian and Saudi airspace as conflict blocks off routes over Iran and Iraq for many carriers. Let's bring in our Middle East aviation reporter, Lian Rashdan. Lian, just talk us through how much disruption has been caused to some of these airlines.
I mean, these are mass disruptions. On October 1st, there were 81 diverted flights, mostly Qatar Airways and Emirates. A lot of airlines are diverting their flights, they're changing their routes, and that's more time spent in the air, that's more fuel spent. So not only are these airlines having to bear the costs of canceling these flights, which are usually profitable routes for them, they also have to pay for the additional fuel, and they have to deal with delayed flights affecting other routes that they have.
Is it going to be costly for them? How much of a material impact is this likely to have?
It probably will, just if not purely the fuel that they're going to spend extra. A lot of the airlines in the Middle East especially have been flying these routes consistently, this entire year. The war hasn't stopped them from flying. But for the first time, we're seeing Fly Dubai stopping flights to Tel Aviv. Usually throughout this whole year, they've been doing these routes, Qatar Airways, Emirates. So this will have some impact on their profit.
And certainly, but from the standpoint of these airlines, how important are these Middle East routes to their overall business?
Very. Emirates uses Iraq or Iran airspaces to fly to most of their destinations, so that's really additional fuel for them. And Lebanon is usually a profitable route, but now all flights have stopped.
With the exception of MEA, of course.
Yeah.
Bloomberg's Middle East aviation reporter, Lian Rashdan. And that wraps up our show, Horizons Middle East and Africa. Daybreak Europe comes up next.